Great. Thanks everybody for joining us. The title of today's panel is How Startups Are Building the Financial Plumbing of Tomorrow. So the pipes and valves of the financial industry is what you're here to learn about. But before we start, I'd love all of our panelists to give a short intro of what you're up to and what you're thinking about lately. If you want to start, Ryan, or we'll go this way.
Sure. Ryan Selkis, founder, CEO of Messari. We're a crypto data company trying to aggregate all the qualitative and quantitative information about these assets to make it a little bit easier for institutional investors to understand and parse, especially if they're starting from zero and trying to quickly come up to speed.
My name is Chen, co-founder, CEO of Lumina. We're your single source of truth for all your digital assets. So we do portfolio management software, accounting software, tax software for people that hold digital assets, moving a lot of hedge funds and family offices off of the numerous Microsoft Excel sheets they're on into something that's a bit more institutional based.
Hi, I'm Greg Tusar, one of the co-founders of Tagomi Systems. Have been in electronic trading for most of my career. At Tagomi, we're trying to bring the sorts of agency electronic tools that you have to trade equities, futures, foreign exchange, etc., into the realm of digital assets, and that's the form of exchange aggregation, market access aggregation, algorithmic trading, smart routing, all in the form of a brokerage service as opposed to a software service to try and help people not have to navigate multiple exchange relationships and OTC relationships.
I'm Sharon Goldberg. I'm co-founder and CEO of Arwen, formerly Commonwealth Crypto. Before starting this company, I was a computer science professor at Boston University. I actually still am a tenured professor there. At Arwen, what we're doing is building a way to securely trade on centralized exchanges. So we're solving the part of counterparty risk. So when an exchange gets hacked, your coins get lost. With Arwen, if you use Arwen to trade at a centralized exchange, then even if the exchange get hacked, your coins are still safe. So what we do is we're not building our own exchange, but we're going into different exchanges and offering Arwen as a feature at those exchanges.
Wonderful, thank you. To kickstart the panel, I want to start with one of my favorite sound bites. We always hear, institutions are coming in 6 to 9 months, and then 6 to 9 months will elapse, and then, just another 6 to 9 months, and it's kind of become a meme of itself. And I'm curious, are institutions here, or where are we on the institution adoption front?
Well, I don't think it happens all at once, and they certainly are coming to a certain extent. You've got pensions and endowments starting to look at private placements and some of the larger crypto-specific funds. Fidelity, ICE, many of the largest institutions are starting to actually build the infrastructure. I think the bottleneck that we've always heard about in terms of actual institutional adoption have been around regulatory certainty. We've gotten a lot more of that recently. Custody. There are now custody solutions and qualified custodians, and then just better order data so that these institutions can actually prove that they've executed trades on a best bid and offer basis. The other thing that no one ever really talks about is momentum, and I feel like now that we've actually seemed to have hit a bottom, or at least things have stopped bleeding out as they were in Q4, now might be a time where you start to see some enterprises accumulate. But probably going to be 6 to 9 months.
So at Lumina, we work with a lot of fund admins, and these are people that work directly with hedge funds to sort through all their data, to bookkeep for these guys. And in all honesty, as of right now, there's about 200 or so legitimate hedge funds out there that do a lot of crypto trading. I hope that number will increase over the next 6 to 9 months. But other than that base of institutional users, honestly, we haven't seen too much more.
I think it's important to parse the word institution because it means so many different things to so many different people. So, we launched at the end of last year, and I would say the vast majority of clients that we're seeing are entities of some sort. So those entities are venture capital firms, they're hedge funds, they're family offices, they're I would say probably 80% of what we're onboarding are institutions in that sense. What we haven't seen a lot of yet are the traditional long-only asset managers who are looking to put client money to work in this asset class. But I would say there's a huge amount of interest, curiosity, and as a firm, we're getting a lot of inbound requests for what if, and what if I tried to, and how would I. So I'm going to guess it's probably another 6 to 9 months.
Okay, I'm not going to make any guesses. So I think one thing that's interesting that I've heard a lot today, because this is actually not the community that I come from. I come from the technology community and cybersecurity community. So this is a really interesting, actually extremely interesting place for me to be, to just listen to the tone of the conversation here. We've had a lot of discussions today about regulation, getting the space ready for the institutional money. And the way that looks like to me is sort of basically creating the institutions that we have in the traditional financial world. So we need custodians, we need exchanges, we need to separate that. We shouldn't have the exchanges be the custodians. But my view and our view at Arwen is that there's so much more you can do with this space because of the existence of blockchains. You can actually do things in a way that are more secure and more trustless than you would have done in the traditional financial world. And so that's actually what we're building. So I think that, it's very early in the way we're taking this approach of going to a centralized exchange and trusting and not trusting them even though you're trading there. You can't do that in the traditional financial world, right? But with blockchains you can. And that's, for me, as someone comes from a cryptography and cybersecurity background, that's what's really exciting. So, as we have this growth towards bringing the ecosystem towards custodians and exchanges and regulation and all of these requirements that you all have because you come from the traditional financial world, I hope, and I am working towards with my team, bringing in some of the capabilities of blockchain to make that actually more secure and provide more capabilities than what you would have had in the traditional financial world. So I hope that will drive some of that adoption, but we're still early on that road.
Absolutely. Regulation is a big part, but I'm happy you started talking about tooling, Sharon, which is the next question. Why do we need different tooling around the crypto asset class versus traditional financial assets?
I guess I'll start. Change it up, I guess that makes sense. If you look at how these different blockchains work, at each blockchain's core, it's a different set of rules. And these rules are not compatible with each other. On the other side of the fence, in the traditional finance world, you have all these expectations set in terms of custody, in terms of how one works with an exchange, in terms of how one works with a prime broker. And these two sets of configuration are currently not congruous. You need a layer of tech to bridge the gap between these two worlds. If you pull someone off the street and ask, how does, count down the list of tokens on CoinMarketCap, how does number 27 work? I'm pretty sure, even the people on the stage, we can't give you an in-depth answer. There needs to be software solutions that wrap on top of all these different technologies and make it accessible for traditional finance.
That's right. I think there are certain things that are in common between other asset classes and crypto. So in other words, if you looked at liquid digital assets, you could probably compare them to how Bitcoin and Ethereum as very liquid on-exchange instruments trade the same way that on-the-run treasuries do, or Microsoft and Intel do, and less liquid ones trade like small cap stocks. And so at some level you can equate digital assets to others. Where it breaks down beyond the actual blockchain technology, to me, is when it comes to settlement, post-trade settlement, pre-trade settlement in certain circumstances, where in the system there's credit risk and to whom you're taking credit risk. And all of those things are completely different than in other elements of the securities world. And so that's why I think you need different tools. There's no credit intermediation, there's no centralized settlement and all of those kinds of things. So that is completely different than what you would find in trading equities or trading futures, for example.
I'll go, then you can go, and then you can start with the next question. That's it. We're gonna do a snake draft. To me, so much of this seems like it's still a back office headache for a relatively small allocation that these funds and other institutional investors are thinking about putting in. How do you handle taxes if the protocol forks? How do you handle staking rewards? Are they dividends? Is it a one-time cash payout? How do you just reconcile these very unique elements of different crypto assets, particularly when it's heterogeneous in terms of how these blockchains and protocols actually issue new tokens or reward the existing holders. So that to me, the tax element, the fund accounting element seems like it's one of the gating items, just because is the juice worth the squeeze for something that maybe an enterprise wants to put 10 basis points into versus make a big directional bet as a large portion of their fund. And I think that's probably why you're seeing crypto funds as the initial power users, and then the ones that might spin off from legacy funds where that have dedicated SPVs to the asset class, even if the larger fund is not traditionally or currently dedicated to crypto in particular.
Okay, I want to take a completely different approach here. So the reason that we need different tooling is because this is a fundamentally different technology that's going to revolutionize the way we trade value. And if we don't have fundamentally different tooling, then we've wasted the entire potential of this space. And so for me, like coming into this space and looking at, we have centralized exchanges that we trust them, we take our coins, we put them there and we trust them, and then they get hacked and we lose our coins, right? So why are we using a centralized point of trust when the entire point of these blockchains is to decentralize things? And so there's so many things that exist in the blockchain world, and the entire, in my view, as someone coming from a crypto background, a cryptography background, the entire excitement for me as a technologist is the way of removing trust or allowing mutually untrusted parties to transact or doing things faster, doing things more smoothly. And so if we don't build different tooling around this, we'll have wasted this opportunity. We might as well be trading corn. Why are we trading Bitcoin, right? And actually, at the end of the day, when you look at some of the systems we're building, you could be using them to trade corn, but we're not trading corn. So what I hope will happen in the next few years is we actually take the potential of these systems, which is like an amazing potential, and we heard Pomp talk about everything is going to be tokenized. Like, why is that? Why do we need to tokenize corn? We have corn, we know how to trade corn. Well, because there's something we can do with these blockchains that we can't do with corn. And so that's what I'm excited about. And so I think that there's a need for new tooling. We're out there building it. We're working through the UX and security and infrastructure issues right now, and that's what's happening in a lot of these infrastructure companies. That's what we're trying to build right now.
Do you think any framing or any tooling will carry over from the traditional financial world and remain relatively untouched, or would work also in the crypto market?
So I'm not an expert in order book technology, for instance, like fast matching engines, but it seems to me like a lot of that stuff will carry over, because at the end of the day, you're matching two people on price. But I think the settlement layers and how the value actually moves, that's the place where a lot of the innovations are going to happen. So, and that's really the reason that there's a lot of value in these blockchains, right? Allowing you to move value in a new way that's digital as opposed to the way we move around corn.
And do you guys agree with that sentiment, or what do you guys?
I agree. I think that was well said. I think that the notion that there's going to be many liquidity pools is true in digital assets the same way that it is in other markets. And if that's the case, I think we should want that for competitive reasons. I think we should want that for fee, competition, and for a whole host of reasons. But as long as that's the case, we need some of the same tools to go find the best price, to figure out who the best counterparty is, to use the best tools, the fastest matching, and all of those sorts of things. And that's definitely what will port over from traditional finance, I think. But I think how, that probably is on its way to a much more decentralized world. It may be a stepping stone to a time when we do have decentralized exchanges, we do have the ability to settle trades in a decentralized way. I don't think that's a permanent state. I think that could be a transitory state as we're on its way, as we start to have more of what the blockchain promises in the form of true exchanges and that sort of thing.
Chen?
Yeah, completely agree. The fact that we have so many of these centralized exchanges where a lot of us do business, and the fact that if you just put in a large amount into a single exchange because you only did KYC with that single exchange, befuddles me. When you sell 100 shares of Amazon on Fidelity That trade is basically sent down the stack, multi-venue DMA. That layer routes that chunk of Microsoft buy orders to the exchange that's out there that's offering the lowest price at that very moment in time. Right now in the crypto world, if you just have done KYC with Kraken or just done KYC with Coinbase, the fact that you don't get that ability to get best bid offer across all of these popular US-based exchanges is absolutely astounding. People like Tagomi are building solutions to basically solve that specific problem. And that's just one problem. There's so many other problems out there on the traditional finance side that need to be solved inside of the crypto space.
Tagomi is also working on that, not just Fidelity. I don't have anything else to add. Those were great answers.
We also see crypto custodians now offering staking support. We saw Coinbase roll out Tezos support as well as governance voting for holders of Maker. And I know your co-founder, Greg, was on Around the Coin podcast, and Mark had stated that you have customers asking for staking support. How are you guys thinking, at large, how is the space thinking about offering staking solutions via crypto custodians or enterprises moving in? What does that scene look like?
It's a good question, and one my co-founders spent more time on than I have, so I'm not sure I'm in the best position to answer, but I do think of the things we're being asked for by clients, it's right up at the top, along with the ability to lend, borrow, and trade on margin. I would say participate in governance and stake are the two things, and we're working hand in hand. So we haven't built our own custody solution. We're working in conjunction with a number of custodians, and that's really the place at which we have to integrate that kind of capability. And so we're relying, I think, to a certain degree, working in concert with others to implement that.
I wonder how much of staking as a service is going to happen at the exchanges themselves. Versus third parties, because it seems a little bit odd that the exchanges would also be the proxy services when you're talking about managing these systems. From just an economic standpoint, I think our team's a little bit skeptical to very skeptical of the economics of staking writ large. It's interesting and I think going to be essential from a governance standpoint, but if you look at the embedded inflation in these different protocols that are proof of stake, the yield that you're getting for staking is often less than the inflation rate. So you've got a ton of tax headache potentially in terms of what the dividends look like or the new rewards that you get from stake, and all at the same time you're getting diluted down in terms of your total network purchasing power for many of these assets. So I think that'll work itself out, but I view this more as who's going to provide the governance services. And so I think some of the third parties that are working on staking as a service probably should be and will be the winners versus this being a native service for an entity like Coinbase.
And who are those parties? Like who are actually working on this?
So a couple have raised money more recently. They're all very early. I think Staked is based here in New York. I'm looking to the front row where I see several investors that probably know this like the back of their hands. Staked would be one. Bison Trails out of Silicon Valley is another that recently raised money. So these services are emerging, but proof of stake blockchains themselves are not necessarily battle tested. So a lot of this we're going to figure out over the course of many years, and I don't think it's really relevant to institutions just yet. Quite frankly, maybe I'm wrong, but Ethereum is still proof of work, and until they find a way to switch, that's going to remain the case for a couple of years at least.
I can ask the next question. We have 4 minutes left. But minimizing slippage is a problem right now that's being addressed, as well as mitigating counterparty risk. And of course, providing order book data and sourcing that. I'm just curious, are there any major problems within trade, either pre-trade execution or post-trade execution, that you guys are seeing that either needs to be solved or new problems that are emerging that you're excited about?
I'll talk a little bit about the tax piece, because it's a big headache for some of these hedge funds that are doing 300,000 trades a day. it's hard to keep up. The back office of counterparts of these hedge funds really having difficulty trying to figure out exactly what happened across a single day worth of trades, especially if you're an algo trader across like 7 exchanges. How do you figure out tax lots accordingly? So I think that piece definitely needs to be solved. Our company, along with a couple other companies, are out there trying to solve this very problem. Greg, anything else?
Yeah. So we, are, I think, somewhat early in the space of providing this sort of agency electronic capability. And so the question we get asked a lot is, how does this compare to the quote I would get from an OTC dealer today? And so, that's sort of on us to show some data about over time. Here are the spreads that you pay generally. Here's what happens if you spread an order out over time. Here's how you would compare that to the volatility over 2 hours or 1 hour. But really to put those tools in the client's hands, it's not exactly a one-to-one, comparison between, the N basis point spread you would get from a quote when you ask for a two-way quote from a dealer. But the important thing is putting the controls in the client's hands so you can determine this one I want to spread out over a day and this one I want to do immediately. But I think the challenge that we have to do is help clients select which of those things make the most sense given the market regime at the time. When the thing's up 20% today, probably a good day to do an immediate risk transfer. The days when vol was down at a 2 or 3% a day type move, easy to spread it out over time and be patient and so forth. So those are the kinds of challenges that we're helping clients think about.
Sharon, did you want to add anything?
So I wanted to talk a little bit about settlement risk and just like the difference between the blockchain world and the regular world. So, we're all familiar with the idea of an exit scam, where you give money or something to someone and they run off with it and never give it back to you. So in the physical world and the regular world, if you have something like an exit scam, that's it, right? Like the person ran off with your assets and that's the end of it. Like you're not going to get them back. I think what's really exciting about this space is that we can actually do things and build systems that prevent things like exit scams, which is not something we can do in the regular world. And so on the settlement side, the concept of an exit scam will similarly exist. You're going to settle with a party, but they disappear and you can't settle. And so even you did this trade and you exchanged some value, but you actually didn't get back what you expected, right? So there's all these notions that I think have been solved in the traditional financial world with different regulations, but at the end of the day, if someone pulls an exit scam on you and gets away with it, there's not too much you can do, right? What we're trying to do here at my company and at various other teams that are really coming at this from a cybersecurity and cryptography approach is to just eliminate these risks. And so from the settlement side, I really think I often hear the discussion as what do we need to do to get this space to be as good as the traditional financial world? And what we're trying to do is make it better than that, right? And the reason to do that is because that's when you're going to start to see other assets being put onto blockchains and being traded that way, because you'll be able to do things with those assets that you couldn't do without these new properties that we're building on that come from the existence of blockchains.
And with that, we've hit 4 o'clock.
Great.
So, thank you all for joining us today. Please find these folks and talk to them after. We just have to have a hard stop at 4 o'clock. Thank you all for joining us. Hopefully you learned something, you're motivated by this, and we'll be back at you soon. Thank you all.